You've probably seen these YouTube videos all over the place claiming that you could pay off your mortgage in 5 to 7 years using something called velocity banking. And that sounds amazing, right? Who wouldn't want to pay off their mortgage in 5 to 7 years without having to make any additional income, right? Just doing exactly what you're doing, shifting some things around, and magically, 5 to 7 years from now, your mortgage will be gone. Well, like most things in life, if it sounds too good to be true, it most likely is. And I've made videos in the past talking about how you can pay your mortgage off faster, strategies behind that. So in today's video, I'm going to show you exactly how amortization schedules work. I'm going to go through examples of how paying additional payments to your principal, how it could impact the final amount of interest that you pay, terms like banks front loading the interest and velocity banking and HELOC and all these things, and explain exactly what they mean and why a lot of these shortcuts really just do not save you anywhere near as much money as they advertise. I hope that you find this one helpful. Let's get to it. All right, so let's start out talking about how an amortization schedule works. I'm going to show you an example using bankrate.com's mortgage calculator. We're going to say that you're taking out a $400,000 loan at a 7% interest rate fixed for 30 years. All right. Now, mortgage rates are a little bit below this as of today, but just to make the numbers easy. So now your fixed monthly payment, which does not change throughout the entire life of the loan, even if you do pay additional principal payments, is $2,661. So that is going to be your fixed payment for the life of the loan. Now, each monthly payment that you make, it includes both principal and interest payments. So there's a portion that is going towards paying down the outstanding balance, and then there's a portion that is going towards paying the bank interest on the money that you owned. And it is very true that in the beginning of your mortgage, a majority of your monthly payment is going towards interest. And it's not because the bank is trying to get one over on you. It is just simple math. It is determined by the length of your mortgage and the interest rate. So when we look at a summary of how much it ends up costing you over the life of the loan, it makes you want to throw up, right? The numbers are very big. When you pay this thing as scheduled over 30 years, we could see the total amount of interest paid would be $558,000, which is insanity, right? The total amount that you repay over the life of the loan is $958,000, which just seems like such a big number on a $400,000 mortgage. So let's see exactly where are they getting these numbers from? How do they calculate this? So the actual amount of interest out of each of those $2,661 payments is just a mathematical formula. And all it is each month they take the outstanding balance that you have. So in the first month, you owe $400,000. They multiply that by the interest rate, which is 7% in this example. And then they divide that number by 12, and that is your monthly interest payment. So in that example, 400,000 times 7%, that ends up being $28,000, right? That's what it would be over the course of a year. You divide that by 12, and we get this interest payment of $2,333.33. And then the additional amount above that to make up that $2,661 payment, that is what is going to go towards principal, to actually paying the balance of this loan down. So you could see at the end of the first month, you owe $399,672. And then to calculate the second month, they do the exact same thing. So they're going to take that outstanding balance, that 399,000 and change, they're going to multiply that by 7% interest, divide it by 12, and that's where you get the second interest payment, which is right here, this $2,331.42. And then the amount above that to make up that $2,661 monthly payment, that is what is going towards paying down the principal. So as you could see, when you spread it out over 30 years, you're barely even putting a dent in the thing in the beginning. And if we go to an extreme on this, let's say, for example, you have an interest-only mortgage, right? With an interest-only mortgage, all you're paying is the interest every month. So your monthly payment in that situation would be $2,333.33. You would have a lower payment every month if you did an interest-only mortgage. You just never pay it off, right? Because you're not paying any principal to it. Now let's look at the other end of the spectrum. If you turn this into a 10-year mortgage, if you said, you know what, I want to pay this thing off in 10 years. Well, first thought is your payments are going to be huge, right? Because you have to pay a lot more towards principal. The interest in that first month, let's see what it is. I'm wondering what you think that interest payment is going to be in the first month. So if I change this to 10 years right here, we could see in the summary the total amount of interest that you pay over the 10 years is much, much less. Well, why is that? It's because you are paying a lot more towards principal. Your monthly payment is much bigger. You want to be done with this thing in 120 payments in 10 years, right? So you pay much less interest because you're cutting 2/3 of the life of the loan off. So in that first month, the calculation does not change, right? You are still getting charged the same amount of interest. So you owe 400 grand, 7%, that's $28,000 a year divided by 12, your interest payment is $2,333.33. What has changed is that your monthly payment is now $4,644 a month. That is the amortization schedule. That is how much you have to pay each and every month to be done in 120 payments. So out of that payment, the first one, your interest payment is that $2,333, and then the amount above that is all going to go towards principal. So in this case, $2,311. So now in the next month, you could see you owe $397,688 because you have that bigger principal payment. So now your next payment is going to be that outstanding balance times 7% divided by 12. And now your interest payment for the next month is $2,319. And the amount above that, the difference, $2,324.49, that is going to go towards the principal, towards paying the balance down. So you are accelerating the payoff in this situation because you're paying so much more towards principal. So yeah, if you could afford it, then do that if you want to pay less interest over the life of the loan. But most people, they can't afford that much bigger payment, so they end up choosing to do a 30-year mortgage where they're keeping the payment much lower, but only a little bit is going towards the principal every month, right? Mathematically, they have figured out how much you have to pay each and every month to be done in 360 months, in 30 years. So now let's say that you could make an additional $300 a month payment. You say to yourself, you know what, I'd like to pay this thing off faster. I have an additional $300 a month that I could throw at it. What kind of impact will that make? And if your mortgage is at 7% and you can afford an additional $300 a month, I think that's a good idea. If your mortgage is at 2.5%, 3%, 3.5%, if you locked in back when the going was good, then I don't think you should throw out your money at your mortgage. Again, that's just my opinion, and it totally depends on what you have going on financially. But let's just take a look. If you take $300 and you add it to the mortgage, so now you can see that first payment, the interest is still the same, right? That $2,333, but your principal payment, it just went up by $300 because you're throwing an additional $300 at it. So now your outstanding balance, it is less because you just made an additional $300 payment. So what happens as a result of that is your interest payment in month 2 is going to be less because they're going to do the calculation. Here's your outstanding balance times 7% interest divided by 12. Here's your new interest payment. All right. So now your next payment, not only are you doing an additional $300 again, but more of your payment is going towards principal because you owe less money on the outstanding balance. And this will continue as you go throughout the life of the loan if you continue making these additional payments. So that's why people say if you throw a big chunk at it in the beginning, if you pay off a big chunk, then it's going to impact dramatically the rest of the amortization schedule, which is totally true. So let's look at an example of that. So now we're taking $10,000, we're making an additional $10,000 payment in month 1 to pay the mortgage balance down. And you can see it does have a very big impact. And the concept of velocity banking is that you would get a home equity line of credit or a personal line of credit, and you would borrow $10,000 to throw at this, right? And they say, we just saved you $100,000 on your mortgage. But you have to take a step back and think about it. So now if you just borrow $10,000, number one, what is the interest rate on that $10,000? And two, how are you actually paying that $10,000 back? Because it has to be paid back. In both cases, you still owe $400,000. And the selling point, what they say is that what you do is you take your cash flow, you take your paycheck. So as you get paid, as money comes in, you dump it into that line of credit. And with a line of credit, the interest is charged daily. Okay. So when you take your paycheck, you dump it into a line of credit, you are reducing the amount of money that you owe in that line of credit. And you are saving money on a daily basis as you've reduced that balance. And then as bills come due, you then live out of that line of credit. You pay your car payment, you pay your utility bills, you pay your mortgage payment. Everything then comes out of that line of credit. And then when you get paid again, you go ahead and you dump your paycheck back into the line of credit. And then you pay your bills. And any positive cash flow you would have throughout the month will go towards actually paying the line of credit. You are reducing the outstanding balance that you have with your positive cash flow. I agree that you are saving money by dumping it into the line of credit. You are saving the interest charges for those days that your money is sitting in the line of credit, right? Because it's calculated daily. But for most people, their bills are due in the beginning of the month. So how many days is your paycheck really sitting or parked inside of that line of credit where you are saving money? And I did this calculation in one of my previous videos throughout a month, and it really came down to dollars and cents that you were saving by going through this process of using a line of credit to knock years off your mortgage. Where I made the argument that whatever positive cash flow you really have, you just take it and you make additional principal payments towards your mortgage, and you come out at the same place than going through doing this line of credit and the velocity banking. Another question I get a lot is, should I use a 0% credit card promo and take that, write one of those checks where they give you 0% for 18 months and throw that at the mortgage? And that could make sense, right? If you have 18 months where you could get 0% and you take 10 grand, you throw it at your mortgage, right? But now you still have 10 grand over here that you have to pay off on your credit card. So it's nice. You're saving the interest. That's all you're saving. You're saving the interest because now you're 0% here on that $10,000, where if you left it in your mortgage, then you'd be paying 7% on that $10,000, right? So over the course of a year, that's $700 in interest you would be saving. But on those promos, you typically have a 3% or a 4% fee up front that you have to pay with those credit card promos. And you have to make sure that you pay the whole thing off by the time the promo expires, because the rates are going to jack up to, 20+% on there, and you don't want to get left holding the bag. So even with that, you have to be very disciplined and be all over it so you don't get left, stuck with that balance on there at that very high rate. And another myth that you will hear pitched in these velocity banking videos is that when you refinance, you're starting the clock over, right? The banks want you to refinance because they want all that interest from you. But that's just not the case. If you take if you have 20 years left on your mortgage, right? Say you started with a 30-year, you've been paying for 10, and you refinance. What you're doing is you're now taking a 20-year loan that you have left and you're pushing it to a 30-year loan. So your payments are going to go down when you refinance in this situation, right? And now when your payments go down because you're spreading it out, you're going to have less going towards principal. So out of your new payment, the amount of interest in that first month is actually the same because you owe the same amount, right? It's just you're now paying less every month because you've refinanced into a lower payment. So less is going to go towards principal. So it's going to take you the full 30 years to pay it off. So more of your payment goes towards interest because of that lower payment. The smart thing to do, if you want to refinance and interest rates are lower, then it definitely makes sense to do so, but keep your term the same. So if you have 20 years left, then refinance into a 20-year mortgage with a lower interest rate. So that in turn is going to reduce the amount of interest that you are paying for the next 20 years for the rest of the life of the loan. All right. Or you can even refinance into a 15-year mortgage. But if interest rates are higher, then obviously you're not going to refinance into a higher interest rate loan, right? And it doesn't make sense to take a 10-year mortgage that you have left and refinance it into a 30-year loan unless you are getting a lower interest rate and your goal is to reduce your payment. But if your goal is to reduce your payment, that means that you are not paying your mortgage off faster in that scenario, right? You are taking longer to pay your mortgage off. It really all comes down to the math behind it. The bank is not trying to rip you off. It is just the math. All right, that is it for this one. I hope that you found it helpful. If you have any questions, this stuff is confusing, right? If you have any questions, you can always email me, rich@schoolofpersonalfinance.com. Check out my website. If you want to work with me one-on-one, I offer hourly financial planning. I'll see you again in the next video. Thanks.